put option is insurance on your stock. And like every insurance policy ever sold, it is priced so that the person selling it comes out ahead over time. That single fact changes how you should use puts forever. Quick note before we start, this is educational commentary, not personalized financial advice. I'm going to show you the mechanism, not tell you what to buy. Here's why this matters right now. Every time the market gets jumpy, retail traders pile into puts expecting a cheap lottery ticket on a crash. Then the crash doesn't come on schedule, the option expires worthless, and they blame their timing. The problem was never the timing. It was that they never understood what they were buying. So let's confront the wrong belief head-on. Most people think a put is a cheap way to profit from fear or a free safety net that just sits there protecting them. Neither is true. A put is a contract that pays you if a stock falls below a set price before a set date. And you pay for that protection up front, exactly like a premium on your car. Let's make it concrete with the simplest case. Imagine you own one share worth $100. You buy a put with a strike of 90. That means if the share drops below 90, the put pays you the difference. Fall to 70, the put is worth 20. So your share lost $30, but your insurance gave 20 back. Your loss is capped. That's the whole idea. You traded some money now for a floor under your losses later. Now here's the shape of the payoff, and it's worth burning into your memory. Below the strike, the put gains dollar for dollar as the stock falls. Above the strike, it pays nothing. So the payoff looks like a hockey stick, flat and worthless most of the time, then suddenly valuable in a fall. That flat part is the key. Most of the time, this thing expires worth exactly zero. So what determines the price? Think like the person selling you the insurance. They ask two questions: how likely is a payout and how big could it be? Multiply probability by payoff and you get the expected value of the claim. That's the fair core of the premium. If there's a 10% chance the put pays you an average of $5, the honest price is around 50 cents. You are paid by expected value, and so is the seller. But there's a second ingredient, and this is where traders get blindsided. The bigger the expected swings in the stock, the more likely the put pays and the more it pays. That's volatility, and it's baked into the price through what's called implied volatility. When fear spikes, implied volatility spikes and put premiums balloon. So the moment you most want protection is the exact moment it's most expensive. Insurance after the fire alarm costs more. Now add time. Every day that passes with no crash, your put loses a little value. Traders call this time decay or theta. It's the slow leak in your insurance, and it accelerates as expiration approaches. Think of it as the daily rent you pay to keep the policy in force. If nothing happens, that rent is pure cost, and it drips out of your position whether the market opens up, down, or flat. Put those pieces together and you reach the uncomfortable truth. Buying puts constantly is a losing strategy on average by design. The seller priced in the probability, the volatility, and the time, then added a margin for their own risk. That margin is their profit and your drag. So if you just buy protection month after month with no plan, you will slowly bleed, punctuated by rare big payoffs that usually don't make up the difference. That's not a flaw you can outsmart. It's the business model of insurance. There's one more quirk specific to the stock market. Skew. Puts almost always cost more than calls the same distance away because markets fall faster than they rise and everyone wants downside protection at once. That crowded demand pushes put prices up. So you're not just paying for the math of a fall. You're paying a fear tax that other frightened investors bid up right alongside you. Here's the line I want you to keep. The premium is the market's fair price for your fear, plus a tip for the seller. Once you see it that way, you stop asking whether puts are cheap or expensive in the abstract, and start asking whether the protection is worth the specific rent right now for your specific position. So what does a disciplined trader actually do? First, they don't buy puts to get rich. They buy them to stay in the game, so a single bad week can't force them to sell everything at the bottom. Second, they buy protection when it's cheap and calm, not after volatility has already exploded. Third, they size it as a cost of doing business, a small, planned percentage, not a swing-for-the-fences bet. And often they finance it, selling another option against it, so they're not paying full retail rent. And here's where this transfers. The same mental model works everywhere. Covered calls, insurance you buy in real life, even a warranty on a laptop. Anytime someone offers to cap your downside for a fee, ask the two questions. What's the probability of a payout and how much would it pay? If the fee is far above that expected value, you're the sucker at the table. If it's fair and the protection lets you keep taking smart risks, it might be worth every penny. So the durable handle. A put is insurance, and insurance is built to make the seller money. That's not a reason to never buy it. It's a reason to buy it deliberately, cheaply, and small only to keep yourself in the game. If you want more breakdowns that give you signal instead of hype, subscribe. Next time your screen flashes red, you'll know exactly what you're paying for and whether it's worth it.